Okay, so we started talking about job order costing last week, and we're going to just expand a little bit on that from last week. We're going to review a little bit and then also um, talk a little bit more about how the money moves through and how the journal entries look. So, so let's just go ahead and go over what we learned last week first. Why is it not flipping? There we go. All right, so we started talking about this last week in chapter 2. So we're just going to go over some of those terms real quick as a review. So we have the job order costing, which is a costing system used in situations where many different products, jobs, or services are produced each period. So we talked about what that would look like, if it was, a large production of the same type of product, you would have one job for that, or it could be one big job. We talked about maybe an airplane, that could be considered one job. So there's different ways to, consider what a job is, but we have job order costing that we use to figure out how we're going to estimate what that cost is for that particular job. And there's software that you can get if you need it to have that for your manufacturer. They could have different types of methods to use for their job order costing as well. And then we have absorption costing, which is a costing method that includes all manufacturing costs, direct materials, direct labor, and both variable and fixed manufacturing overhead and the cost of a product. So we talked about those three things: direct materials, direct labor, and manufacturing overhead. So we talked about that since chapter 1. So we're going to be looking at that again. All right, the equation shows us how to calculate the predetermined overhead rate. So remember, we talked about we need to come up with what that estimate's going to be for the year. And we have to look and see, like, what are we estimating costs to be? What are we going to have the cost driver? So we have our allocation base, a measure of activity such as direct labor hours or machine hours that is used to assign costs to objects. So that's our cost driver. So that was that bottom number. So when we had the equation, we had the cost at the top, and then we had that allocation base at the bottom. We have a predetermined overhead rate, a rate used to charge manufacturing overhead cost to jobs that is established in advance for each period, and it's computed using the following equation. So here's the equation again. It's the estimated total manufacturing overhead cost divided by the total amount of the allocation base. So our cost in dollars over whatever the allocation base is. So if it's labor hours, then it would be however many labor hours that is. And we calculate that so we can come up with, well, how much is it per labor hour or per machine hour? And we can use that and we can assign it to the cost based on a job, based on how much machine hours were used or how much labor hour was used on that particular job. So remember, it's an estimate that's figured out before the period, and you're using that rate through the period. And then in the end, you're going to be comparing what your actual was to what you estimated. And we walked through all that process last week, and sometimes it doesn't work out perfect. It probably never will. Sometimes it's over or under applied. So we're going to look at that again this week. All right, so we have overhead application. So that's the process of assigning overhead costs to specific jobs using the following formula. So we have an overhead applied to a particular job. So we're using the predetermined overhead rate, which is that formula that we just looked at. We calculate out how much is it per labor hour, per machine hour, and then we multiply it by the allocation base incurred by the job. So if it's direct labor hours, it's however many labor hours was on that job, and you multiply it by the predetermined overhead rate per hour. Then we have our normal costing, which is a costing system in which overhead costs are applied to a job by multiplying the predetermined overhead rate by the actual amount of the allocation base incurred by the job. And we have our job cost sheet. So this is that form. It records all the direct materials, direct labor, and manufacturing overhead costs charged to a job. So in the example, I just showed you a little sheet and it listed all of that out. So now with, software, you're going to have some type of computer system that's going to run reports for you and show you what materials were used, what labor hours are on there, how many. It's going to calculate all that for you. what manufacturing overhead costs are coming into the job to give you a total job cost. And then you can see how much it was depending on how many units you produced in that job. You can find out how much it is per unit. So we looked at that little sheet last week. All right, so we want to understand the flow of the cost in a job order costing system and prepare the journal entries. So we're going to be focusing on that a little bit tonight. And then we're going to use T accounts. And T accounts we talked about in principles, but I'll go over that again just to make sure you understand what the T account is. And in order for you to be able to understand it a little better. All right, so we have a balance sheet. Our balance sheet has assets, liabilities, and owner's equity. Part of our assets are all this material that we're housing in a warehouse that we're going to be pulling from. That's our raw material. That is going to be used to go into the final product. So throughout our process, we're going to be pulling raw material. Another asset account is work in process. So that's everything's moved out of that raw material. It's gone into work in process. Whenever we have guys that are put on the job, we have labor, and those direct labor hours are going to go into that work in process. And then we have our manufacturing overhead that's also being pulled into our work. Can y'all hear me?
Yeah,
Hello?
well, I can hear you. I can hear you.
Okay, did y'all hear me lecturing and then it went out?
Yeah.
Okay, so did y'all hear me all the way up to this screen with the raw materials work in process?
Yes, ma'am.
Okay, good. So did y'all hear finished goods? I don't know when it went on mute.
Yeah, I think that was the last one you were on.
Okay. All right, so the finished goods is also an inventory. That is our finished product. That is what's available to sell. So it's sitting as an asset in a different account. So just remember that all three of those are asset accounts: the raw materials, the work in process, and the finished goods. They're just sitting in different pots. And so we have to follow the money and how it's moving from one group to another. And so we're going to look at that tonight. But the finished good is that completed product. That's what's ready to go for sale. And then we have our cost of goods manufactured. So this isn't sold yet. This is just how much was the cost to manufacture that product. So it includes manufacturing costs associated with the goods that were finished during the period. So only products that were finished, we're going to be looking at those goods
Ma'am,
manufactured.
I can't see your screen.
Oh. All right, is it back now?
Yes.
So I don't know what happened. It like glitched out or something. I was talking, all of a sudden it muted me, and then y'all came back up with all the different windows, which now I've lost. Hang on, let me open that back up. And then I need to get the chat window back up just in case. I don't know what happened. Okay. All right. So we have the cost of goods manufactured. Now remember, that's not what's sold. Cost of goods sold is what's sold. This is what's been manufactured. All right, so here's the flow. So the first column shows our cost. So we have raw materials, direct labor, and manufacturing overhead. That's all of our product costs. It shows that it's sitting on the balance sheet. That whole green area is the balance sheet. So all of those things are being pulled in on the balance sheet. And then we have, in the balance sheet, we have our raw materials, which is that direct materials that we're using in the production, which is going to go in work in process. We have the labor of whoever's working on that particular job that's coming into the work in process. We have an allocation of our manufacturing overhead that's coming into work in process. And so that is all, both are considered inventory. And then when we're finished, that cost of goods to complete, which is the cost of goods manufactured, is going to be pulled out and moved into finished goods, which is also an inventory account. Okay, so you see them all sitting on the balance sheet. So this is just what I was talking about, but this kind of gives you a visual, and I think this is a good screen. Are y'all there?
Yeah,
Yeah.
we're here.
Okay, so it glitched out again. I don't know how much y'all heard me. Something's happening, I think, with my internet. It's going in and out. So it seems like it keeps like disconnecting. Sorry, guys. And I'm hardwired in. I'm not even on Wi-Fi. So maybe I should check that real quick. Hang on. Let's see. No, it says I'm hardwired on. I wanted to make sure it wasn't connected to the Wi-Fi. Okay, let me try again. All right, so there's a little screen that we were just looking at. I don't know what the last thing you heard was, but what I was saying was that all of your inventories are on the balance sheet. And then in order to move to the income statement, the finished goods, when you sell them, they're going to go onto the income statement. And the cost of all those goods are called the cost of goods sold. And then you also have your selling and your admin expenses that will hit the income statement as well. All right, so we're going to look at this example here. So it says, to illustrate the cost flows within the job order costing system, we will record Rugger Corporation's transactions for the month of April. So Rugger is a producer of gold and silver commemorative medallions, and it worked on only 2 jobs in April. So we have job A. It's a special minting of 1,000 gold coins commemorating the invention of motion pictures, was started during March and completed in April. So as of March 31, job A had been assigned 30,000 in manufacturing costs, which corresponds with Rugger's work in process balance on April 1 of 30,000. So you see it's still in work in process. We have manufacturing costs of 30,000 that's been assigned to that job A. Then we have job B, in order for 10,000 silver medallions commemorating the fall of the Berlin Wall, was started in April and was incomplete at the end of the month. Okay, so it's incomplete. We're not going to move that, right? We're going to leave it in the work in process. All right, so let's look at the T account. So the T account is just breaking out each account. So right now we're looking at 3 accounts. We have the raw materials account, we have a work in process account, and we have a manufacturing overhead account. So in the raw materials, when we purchase raw materials, that's an asset. It's going to be sitting as a debit on our books. When we want to move the raw materials out, we're bringing it over to work in process because we're using that to produce our product. So it credits raw materials and debits work in process. Then we have our indirect materials, which is that manufacturing overhead. It's going into that. We have 2 things happen in that manufacturing overhead account. So you can see one side, which is the debit side, has our actual indirect materials. So we're pulling those indirect materials and we're actually costing them out to manufacturing overhead. Then we have on the other side, the credit side, our applied manufacturing overhead. So as we apply to the job, we're going to pull it. It's going to credit the applied on the manufacturing overhead. And it's going to move over to work in process as well. So everything's going to hit work in process as that debit. So let's look at the journal entry for the materials. So we have a purchase of raw materials in journal entry form. So on April 1, Rugger Corporation had 7,000 in raw materials on hand. During the month, the company purchased on account. Remember, on account means that they're buying it on credit, so not paying cash yet. An additional $60,000 in raw materials. So we already have 7. Now we're buying 60,000 more. So the journal entry is going to put the debit to raw materials to bring that into our inventory. And the credit is not going to be cash. It's going to be accounts payable because we're buying it on account. So we're not paying cash yet. All right. During April, we have materials requisition forms. which are prepared to authorize withdrawing 52,000 in raw materials from the storeroom to use in production. So we pulling that out, we're going to bring it into work in process. So these raw materials include 50,000 of direct materials and 2,000 of indirect materials. So remember, direct materials are real easy to flow. We can pull those materials out, put them right on the job. The $2,000 of indirect materials, that's going to be our manufacturing overhead. That's our actual. So we have to record it and keep track of it. So remember that manufacturing overhead has two things happening. You have that actual, and you also have those estimates that can be applied to a job. All right, so the journal entry, 50,000 in direct materials. So we're pulling that out of raw materials. We're putting it into work in process. They're asset accounts, so their normal balance is a debit. So on the raw material side, if I'm pulling it out and I want to reduce, I have to credit. And on my work in process side, I'm going to be increasing it, so I have to debit. So I have a debit to work in process for my direct materials of 50,000. Then I have that actual indirect material that was pulled for manufacturing overhead of 2,000. And then there's my credit for the raw materials for 52,000. So all of my materials are being pulled out. You notice that the direct materials are being identified, and they're handled a little bit different than the indirect materials because they're part of that manufacturing overhead. All right, so now let's look at our labor. So here's the T account for the labor. So we have our salaries and payables, salary and wages payable. So anytime you have an account that says payables, you know that you have to pay that in the future. So what kind of account is a payable? That is a liability, which carries a normal credit balance. So you look on your T account, you see that direct labor sitting there as a credit because we're liable to pay somebody in the future. It's a liability. So it's got a credit balance. And we're moving what's happening with when we pay somebody to work on a job, that's considered work in process while we're working. So we're going to credit that payable account so we can set up what we're going to be paying in the future. And we're going to put the debit over into work in process. Okay. And that's going to all pull to that job cost sheet. That's why it's got that noted there. And then we also have our indirect labor. Those labor hours that are not easily assigned to a job. So we have those, and we're going to put the credit to the payable account, and then we're going to have that debit going into the indirect labor is going to go into the manufacturing overhead as the actual, because that's the actual labor that we're paying. All right. In April, the employee time tickets, which provide hourly summaries of each employee's activities throughout the day, include 60,000 recorded for direct labor and 15,000 for indirect labor. So we want to look at the.
You want to go back outside?
I'm sorry, what?
Oh, sorry. I was talking to my dog. Sorry. I thought it was muted.
Okay, I'm gonna go ahead and mute you. All right. So we have 60,000 in direct labor. So we're going to pull that out, right? We're going to put that into work in process, and we need to pay somebody for that, right? That time that they worked. So we're going to have our credit in salary and wages payable. It's a liability. We're paying it later. And then we have 15,000 in indirect labor. So we're still going to have to pay those people as well. It's just not something that's easily traced. So it's considered an indirect labor. We're going to go ahead and go to manufacturing overhead with that money. So it's 15,000 for manufacturing overhead as a debit. And then we're going to also include that in our salary wages payable because we're going to be paying someone in the future. So it's a liability. It's going to be a credit. So just keep in mind when you see the direct labor that goes to work in process, that indirect labor is going to go to manufacturing overhead. All right. So we're looking at our T account again. We have our salary wages payable. So we have our direct and indirect labor. We just took care of that. We moved it over into work in process for direct labor and direct materials. We moved over our indirect materials and indirect labor over to manufacturing overhead. Now we have other overhead. So let's go through that. So we have utilities of 21,000. We have rent at the factory for 16,000. And then we have miscellaneous overhead costs, and that's 3,000. So we're going to add those up because that's all part of the factory cost during April. So we're going to add them up, and that is going to go into manufacturing overhead as a debit and accounts payable for $40,000. So typically what happens whenever you have utility bills coming in, or if you have rent, you have different payable accounts that will show on a register. Right now, we're not worried about breaking all of that out. We're just adding it all together and calling it accounts payable. But typically you would see all of that separately go into an accounts payable account. But for now, we're just looking to see what the total cost is. So we're just going to add it together. It's going to go to accounts payable as a credit, because remember, we're paying somebody, we're liable to pay them in the future. So it's a credit balance. So that's why it's set up as a credit. Manufacturing overhead is 40,000. That's our actual cost. And remember, when we're looking at that T account, on that left side, the debit side was all of our actuals, what was happening. So we're doing the actual right now. So that's why it's a debit. Okay, so now we're looking again at the little summary, and we've added our other overhead to the manufacturing overhead under the actual side, which is a debit. So now we're going to look at the applied. So the applied is what that estimate was that we came up with and how we're going to calculate it and bring that into the work in process based on whatever job costs, whatever cost driver we've assigned. Okay. So assume that Rugger Corporation predetermined overhead rate is $6 per machine hour. So we're basing the allocation basis at machine hour, and we're saying that it's $6 per machine hour. That is our predetermined overhead rate, which is that estimate. That's what's done before the period starts. And then assume that during April, 10,000 machine hours were worked on job A, 5,000 machine hours on job B, for a total of 15,000 machine hours. So thus 90,000 in overhead costs. So how do we calculate that? We're adding those machine hours. We have 15,000 machine hours together, right? So we had 10 and 5. So we're adding those together to come up with a total machine hour of 15,000 hours. And what was our predetermined rate? It was $6. So we're going to multiply that together to come up with 90,000. That is what's going to get applied to the work in process for those jobs. So the entry, we're going into work in process, so it's a debit. And what is on the manufacturing overhead T account? Remember, we looked at it. The debit side is the actual. The credit side is for the estimate. That was for the predetermined overhead rate, the applied amount. So the credit is to manufacturing overhead for our applied amount. So that's how we're going to be able to tell if we're over or under. So we have both things happening in that account. So while we're costing out things, we're using that estimate. So here's the estimate, 90,000. Then we have non-manufacturing costs. They're not assigned to the individual job, rather they're expensed in the period incurred. So we have salary expense of employees who work in marketing, selling, or administrative capacity. And then we have the advertising expenses that are expensed during that period incurred. So let's look at those. So we incur 30,000 in selling and admin salary cost during April. So the journal entry, we're going to have to debit an expense account, salaries expense for 30,000. And remember, we got to pay them. So we're liable to pay them. So it's a payable account, salaries and wages payable, credit of 30,000. So remember, that's a liability account, carries a normal credit balance. So that should help you know, okay, that's going to be my credit. Then we have depreciation and office equipment. April was $7,000. So we're going to do depreciation expense, 7,000. We're going to credit accumulated depreciation of 7,000. And that's going to offset that asset that you have on the books for the equipment. Then we have advertising, that was 42,000. And we have some other selling and admin expenses that are 8,000. So let's record those. So we have advertising for 42,000. That's a debit, that's an expense. And then we have our other selling and admin expense. It's a debit for 8,000. And then we're going to total them together to come up with what are we going to have to pay out. That's our accounts payable. And that is 50,000. So if the problem tells you that they bought it with cash, your credit wouldn't be accounts payable. You wouldn't have a liability. You would have cash going out the door. Well, it's an asset account that carries a normal debit balance. When cash is decreasing, then you would have to credit cash. So instead of accounts payable, it would be cash. So just make sure you read the problem to know if you're buying on account or if you're paying cash. All right. So are you with me so far with our work in process, the journal entries, how things are flowing? Also that selling and admin, we're going to go ahead and expense it right when it happens. So y'all good so far?
Yes.
Okay. So let's look at, we're in work in process. We brought all of this in. We did our direct materials, our direct labor, and our manufacturing overhead, which is that applied amount. So that's that estimate. That all comes into work in process. So at the end of the period, we're going to be looking to see, have we finished any of the products? And we usually do. So now we're going to calculate what the cost of goods manufactured was. So that's everything that we did that period. We've manufactured it and now it's completed. We want to move it out of work in process and we want to move it to finished goods bucket. So now we have finished products. So what are we going to do to pull it out? If it's sitting there as an asset, in order to reduce it, we have to do the opposite, which is credit. So we're going to credit that work in process and we're going to scoot it over to finished goods, which is going to be a debit. So remember that left side is a debit, that right side is a credit. All right, so job A was complete during April and job B is incomplete at the end of the month. So do you think we have to pull out job B if it's incomplete? No. We're not going to pull that out because it's still considered work in process if it's not complete. All right. So we finished job A. So that's what we're going to move into finished goods. So job A is 158,000. So we're going to debit the finished goods for 158. So we're just moving it out of one pot, putting it in another. So it's coming in, it's a debit. Work in process, we're reducing that. So that's going to be 158,000. And then we have job B not complete at the end of the month. Its assigned cost will remain in that work in process and it will carry over the next month if it's completed. So if a balance sheet was prepared at the end of April, the costs accumulated thus far on B would be 72,000. So you would have to go back on the other slides and look at all the costs and add it up. But the remaining part of job B would be 72,000. That's going to stay in work in process. All right. So now we've moved our product out of work in process. We've finished it. We have our cost of goods that was manufactured. We've moved it over into our finished goods. So now in the finished goods inventory, we have product we can sell. Now we sell. So when we sell, we have to remove that cost off the books. That's called cost of goods sold. Okay, so it's not cost of goods sold until you actually sell it. So what we sell a product for and what the cost it was to manufacture it are two different numbers. Hopefully you're selling it for more than it cost you to build it, or you're not making any money, right? So our cost of goods sold, we're going to have to capture that, get that inventory off the books, and we're going to have to record that cost of goods sold. So since we're moving it out of finished goods, we have to reduce that account. So how do we do that? With a credit. So we know we're going to be crediting finished goods. Where is it going to? Where's the other side? That debit is going to be cost of goods sold. So we're also going to have another part to that, because remember you have the sale amount and you have to record the sale as well. So you're going to have two parts to your journal entry when you sell a product. So let's look at that. So we have Rugger Corporation. We will assume 750 of the 1,000 gold medallions in job A were shipped to customers by the end of the month for total sales revenue of 225,000. Because 1,000 units were produced and the total cost of the job from the job cost sheet was 158,000. All we're going to do is divide that up, 158,000 divided by 1,000 to come up with that unit product cost, which is 158. And then we have to record the journal entry. So remember we sold it for 225. So we have to record that. It doesn't tell us that we collected the cash. It does, well, it's just assuming that it's on account because it doesn't say we collected the cash. It may say that they bought it on credit. It may say that they bought it on cash. If they say they bought it on cash, obviously you're receiving cash in. So you want a debit cash account. That's your asset. That's your debit account. If it doesn't tell you that they paid cash, it might say they paid on account, or it doesn't really specify here. You want to go ahead and go to accounts receivable. So accounts receivable, remember, we're going to receive money in the future. So debit accounts receivable, that's our asset account for 225,000. The amount that you're putting on the books that you're going to be collecting later is the amount that you sold it for. Your sales that you're recording is also what you sold it for. So you credit the sales for 225,000. So that's the first part. You record in the sales. The second part is to remove the inventory off the books and then cost it out so that it offsets that sale amount that you just brought in. So cost of goods sold is a debit, finished goods is your credit, and it's for the cost. So remember, it's 158 per unit. So it's the 158 times 750. We come up with 118,500. So the easiest way I think to remember that is if you're selling goods that are finished goods, you're selling that off the books, you need to reduce it. What is it? It's an asset account. So it's sitting as a debit. Well, the way that I reduce that is by crediting. So if you know that you're crediting your finished goods, you'll remember that you got to debit your cost of goods sold. All right, so now we're going to prepare the schedule of cost of goods manufactured and the cost of goods sold. So remember, manufactured is just what's coming out of that work in process, and the cost of goods sold is what was actually sold. So we're looking at what was manufactured and what was sold. So we have three costs, same three costs we've been talking about: direct materials, direct labor, and manufacturing overhead. So the schedule calculates the cost of raw materials, direct labor used in the production, and the amount of manufacturing overhead that was applied to the production. So remember, we're using that estimated amount. And then we have the manufacturing costs associated with goods that were finished during the period. So we want to move those out of the work in process and bring them over to finished goods. All right, so this chart kind of shows you that. So we have our raw materials during the period, and we have the beginning raw materials is what we already had. Then we probably had to buy some more stuff. So we have raw materials purchased. So we add that to the beginning balance. So whatever we have in the beginning, we're buying more stuff. So we're going to add to it. So that gives us the ending raw materials that's available that we can use. And then we have to deduct out, what are we taking out of the raw materials? That's our direct materials that we're moving over into that work in process. So we have that's happening as well. So the way that this shows you is it doesn't give you that amount. Sometimes the problem might, but on this chart, it's saying, okay, if you have a total raw materials that are available, and I'm giving you what's left in there at the end, the difference between the two is what you actually used and brought into work in process. So that's the raw materials used in production. Okay, so the raw materials is pulled out, it's put into your manufacturing cost, that's your direct materials. All right, so then we have our direct labor that gets added in, and then we have our manufacturing overhead that gets applied. So that is our estimated overhead that we calculated in the beginning of the period, not the actual. So remember, that's the amount that's applied, that's the estimate. So we have to take all of that and add it together to come up with the total manufacturing cost. We have our work in process account. So we have a beginning work in process because we had some stuff from the previous period that wasn't completed that's still sitting in there. So remember, job B wasn't finished. So that's in the work in process. That's maybe your beginning balance. Then we have to add in all the costs that were brought in. So all of our direct materials, direct labor, and manufacturing overhead applied. We're pulling that in. We're going to add them together for the total work in process for that period. Now, remember, some are going to get finished during the period. Some are not. So in this example, it's saying that you're going to deduct out the ending work in process inventory. Obviously, if it's not left, that is what has been completed and has moved on to finished goods. So your problem could say, this is what your total work in process was. Here's what your ending work in process was. When it does that, you know you have to take the difference, and that difference is what the cost of goods manufactured was that's going to be moving over. So sometimes they give you the number, sometimes they don't. So just remember, for the work in process, we have our beginning work in process. We add all of the costs for manufacturing to it to get the total for the period. We deduct the ending work in process, and that gives me my cost of goods manufactured. So that's what's completed, and it's going to be pushed over into my finished goods. So on my finished goods side, I also have some product that's been completed, ready to sell. It's, in my beginning balance that's carried over from a previous period because we didn't sell everything. So remember our medallions, we had 1,000, we only sold 750. So we had that remaining 250 that's in our finished goods. Now this next period, we're bringing in more. So now we're finished some more product. We're bringing that into our finished goods. So we add it together. That gives me all of my goods that are available for sale. Okay, so I have my beginning inventory plus what was manufactured. That's giving me my availability to sell the products. Okay, then the problem on this case could tell you what the ending finished goods are. That difference is what you actually sold. So that's your cost of goods sold. Sometimes the problem may give you the cost of goods sold and they want to know what the ending is. You would do the same thing. You would say, okay, here's what's available. Let me deduct out my cost of goods sold. The difference is what my ending is. They give you the ending, you do it this way. Okay, so this is your formulas that you're going to be using. So I think these could be helpful when you're doing your homework and trying to figure out, okay, let me try to track, see how I got to get the numbers. So if you can follow what's actually happening, if it makes sense, you should be able to work through the problems and get the journal entries done. Okay, so remember, finished goods is what we actually sold. So we have cost of goods sold. All right, so let's look at an example. So we have our beginning raw material of 32,000. During the month, 276,000 of raw materials purchased. And we count at the end of the month, it reveals that we have 28,000 in raw materials still in inventory. So it wants to know what is the cost of the direct materials that were used. So we're getting the ending inventory, so we need that difference. This is exactly the way the tables were set up that we just went through. So how do we do that? We take the beginning balance of inventory. We bought more, 276,000, so we're going to add it together. Let me see if I can get my pen to work here. So, all right, so we have that 276,000 that we bought. We have the beginning 32,000. So this is my raw material that I have available. Because this is what I started with. That's my start. This is what I bought. So that's my purchase. And that is 308. All right, so that's what I have available to use in material. It's giving me my ending balance. They say in the ending balance is 28,000. So I need to take the difference to know what was actually used. What did I pull out of direct materials and move over into that work in process? I need to know that number. How do I get that? I take the difference. 308 minus the 28,000, that's 280. So the answer is going to be C. All right. All right, there it is. It breaks it out for you. All right, so we have direct materials used in production that cost 280,000. We have direct labor of 375,000 and 180,000 of manufacturing overhead was added to production for the month. What were the total manufacturing costs incurred for the month? So remember, we have direct materials, direct labor, manufacturing overhead, and what did we have to do? We had to add all those together to find out what the total manufacturing cost was that was incurred for that month. So they're giving it to us 280, 375, and 180. So we have to add all those together to come up with 835,000. So the answer is B. Okay, so we just add them up, those three pots. All right, we have beginning work in process that was 125,000. Manufacturing costs added to the production for the month were 835,000. And there was 200,000 of partially finished goods remaining and work in process. So that's what's not finished. So what was the cost of goods manufactured during the month? So we have our beginning work in process of 125,000 plus that manufacturing cost, the 835,000. So we're going to add that to get our total work in process. So we have 960,000. Now it tells us what our ending work in process is. So we're going to take that out. So that's the ending work in process. It's 200. So the difference is what was completed. That was the goods that was manufactured. That's what we're going to pull out, and we're going to move it over to the finished goods. Okay, it's coming out of work in process. So that difference is 760,000. So C. All right, now we're looking at finished goods. So we have our beginning finished goods inventory at 130,000. The cost of goods manufacturing for the month was 760. So we're pulling that out of the work in process, putting it in finished goods. And at the end, the finished goods inventory was 150. So it wants to know what was your cost of goods sold. So again, we're going right through. So this is my beginning, 130. The way that those slides were set up to show you how you move the money through. So we had the finished goods of 130,000. We had that cost of goods manufactured of 760,000. So what total is that? That's 890,000. Okay, that's the finished goods inventory that's available that I can sell. Now, how much is left in my ending inventory? It's saying that the ending finished goods is 150,000. So I have to take the difference to come up with what did I actually move over to cost of goods sold? What actually sold? So it's 740. Just taking the difference, the 890 minus that 150. So B. Okay, so there it is, just adding it up for you. All right, so last week we talked about that over and under applied. So let's look at that. That manufacturing overhead account that we were looking at. Remember that left side was the actual, that right side was the credits. So we have to look and see, was it over or was it under applied? So that under applied overhead exists when the amount of the overhead applied to the jobs during the period using the predetermined overhead was less than the total. And the over applied overhead means that that predetermined overhead rate was more than what actually got applied. Okay, so the over is when you have too much on your estimate, and then the under is when you don't have enough on your estimate. So we have Pearco's actual overhead for the year at 650,000 with a total of 170 direct labor hours worked on jobs. So the predetermined overhead rate is $4 per direct labor hour. So remember that predetermined overhead rate is an estimate, and we're going to multiply that by the direct labor hours. So we're going to do the $4 per labor hour and multiply it by the 170,000 hours. So that gives us 680,000. So that's how much we applied. That was our estimate, 680,000. Well, the actual was only 650,000. So we over applied. We put too much. So we over applied by 30,000. Okay, so remember I told you we're going to get to what do we do with that overage or under, and there's a couple of different ways you can do that. We'll look at that in just a minute. All right, so we have on this example, Tiger Inc. had actual manufacturing overhead cost of $1,210,000 and a predetermined overhead rate of $4 per machine hour. So Tiger Inc. worked 290,000 machine hours during the period, and Tiger's manufacturing overhead is what? Is it over or under applied? So let's look at it for a second. So what is our predetermined overhead rate? It's $4. We need to multiply that by the machine hours because that's our cost driver, 290,000 hours. So that's going to give me 1,160,000. So that's what we applied. Well, if you look at the actual cost, it was 1,210,000. So that difference is going to be the over or under. And was it over or under? We put less, so was it over or under applied? Because it's less than the actual.
It's
Under.
under.
Yes, it's under applied. And the difference between the two is the 50,000. So our answer is 50,000 under applied. It's going to be B. Yeah, so we're just comparing what did we estimate it to be, and compare that to what actually hit that manufacturing overhead account, what was debited to it during that period. So we're just comparing the two and we're going to take care of that difference. Okay, so the 30,000 overhead applied, it can be disposed in one of two ways. So we can just take the 30,000 and throw it into cost of goods sold, or we can allocate it between work in process, finished goods, and cost of goods sold. So that would be an allocation based on their balances in those accounts. So obviously the second choice is going to be a little bit more complicated. The first one's easier. However, the first one might not always be the best way to take care of those, because not all of the product was sold. You still have some product that's being produced. You still have some sitting on the finished goods inventory list. So it's probably more accurate to break it out, but it is a little bit easier to do it this way. And just absorb all of that cost at one time and not spread it. So let's look at the T account. So right now in the manufacturing overhead, on this side here, we have our debit, which is what's happening with actual cost. And then over here on the the right side, we have what actually was applied. That's our estimate. So we have 30,000 that was over applied. So we need to move it out of that. So right now we have a credit balance in this account. How do we clear out that credit balance? We have to make a debit. So we're going to debit $30,000 to that manufacturing overhead. All right. So once we do that, then this now is going to be zero. So we're taking care of that overage, and we're putting it to cost of goods sold. So since we over applied, we're reducing the cost a little bit. So that's going to look better for us because now we don't have as much cost. We're going down by 30,000. So let's look at it if we allocate. All right, so they're going to give us the allocation. We need to have those ending balances in order to know how to do the allocation. So it's telling us that we have work in process, ending finished goods inventory, and cost of goods sold. So we have 68, 204, and 408. Total of 680,000. So all we're going to do is allocate a percentage to each one of those accounts. So for work in process, that ending balance is 68,000. So we're just going to take that and divide it by the 680 and come up with what percentage it is, and then do the same for the other two accounts. So let me show you the math. It'll be a little bit easier if you can see it. So here we go. So ending inventory, 68,000. We're divided by 680,000. It's allocated 10%. Finished goods had 204. So we divide it, we get 30%. And then cost of goods sold had 408. So that's going to get 60%. So the majority of the allocation is going to go in cost of goods sold, but the cost of goods sold isn't going to get the entire 30,000 now. It's only going to get 60% of that. The rest of those, the rest of the overage is going to go into work in process, into finished goods. Okay, so this is how we would break it out. So we have our percentages based on what we just calculated. That's the first two columns. And then we're going to use those percentages to break up the 30,000. So work in process is 10%. So we take 30,000 times 10%. For cost of goods sold, it's 60%. So we take the 30,000 and multiply it by 60%. So now our journal entry is going to be a little bit different because we have three accounts that we have to put the money in. and remove it out of our manufacturing overhead. So here's our entry. So how do we get it out of manufacturing overhead? We're sitting with a $30,000 credit. We're going to debit the $30,000 to manufacturing overhead. Then we're going to break out the work in process, finished goods, and cost of goods sold. We're going to credit for the amounts that we just calculated. So this is how we do in our allocation. We're breaking it up between all three accounts and pulling it out of that manufacturing overhead so we can have a zero balance in that account. All right, and so this I kind of talked a little bit about that we can close it to cost of goods sold. That's the easier way to do it. However, when we allocate between the three accounts, it's probably a little bit more accurate, and maybe they don't want to do it because it's a little bit too complex. So it just depends, but it probably would be a little more effective if you did it where you broke it out between the three accounts. All right. So what effect will we have if the underapplied overhead have on the net operating income? So we have underapplied. So this is where our actual costs are more than our estimated cost. So it's underapplied. So what do you think happens to income? So think about it for a second. If our actual cost is is more than what the applied was. The applied's what got moved to cost of goods sold. Okay, that's what went in. So what happens to operating costs? Well, if I have to do a journal entry to fix that, I have to put more cost into into my cost of goods sold. So my operating income is going to show higher than it should be because I don't have enough cost allocated to the job through my applied. So when I look at my income statement, I have more income and operating income than I should. So when I do the entry to fix that under applied, I'm going to have to debit that cost of goods sold, which is going to bring down my income. So that's what happens with under applied. And let's just, they don't have the example with the over, but let's say it's over applied. So what happens then? So it's over applied. So when I brought the number in for the cost of goods sold, I had too much. I applied too much cost. So that entry that we just did, we're reducing that cost, that cost of goods sold. So since we're crediting the cost of goods sold, that means that I'm lowering the cost. So if I look at my income statement before I do the entry, I see my net operating income. After I do the journal entry and I reduce my costs, what happens to my income? It's going to go up. So in that case, with the over applied, then my income was showing less than it should have been. Okay. I hope you understand that. So if it's under applied, operating income showing higher than it should be. And if it's over applied, then my operating income is less than it should be. Does that make sense? Y'all still with me? I see
Yes,
y'all.
I'm still with you.
What you said?
No, I'm still with you.
Okay, because y'all quiet, but I see y'all still there. So, but that is everything on chapter 3 with the job cost. So, do you need me to go over any of it again, or did it make sense? Do y'all need to go over
No,
any?
I'm good.
It's good. Okay. All right. So so that is the end of chapter 3 lecture. And I want to open it up to see if we have any questions for chapter 2 homework or anything in the chapter here. No questions, no problems with the homework.